Something's happening in the silver market that most people aren't paying attention to. While everyone's watching the headlines and the daily price movements, there's a structural shift taking place that's forcing smart money to completely rethink their position on physical silver. And the number that keeps coming up in private conversations among serious investors is 250 ounces. Not 100, not 50, 250. Let me show you why that number matters more now than it ever has before. The silver market is experiencing its sixth consecutive year of structural deficit. Think about what that means for a moment. 6 years in a row where global demand has exceeded supply. This isn't a temporary imbalance. This is a fundamental restructuring of how silver flows through the global economy. Industrial demand alone is consuming massive quantities, and that's before we even talk about investment demand, or what central banks are quietly doing behind the scenes. Here's where it gets interesting. The registered inventories at COMEX, the exchange where silver futures are traded and settled, have fallen below critical thresholds. We're talking about the physical silver that's actually available for delivery against futures contracts. When you look at the ratio between open interest in paper contracts and the actual physical metal available to deliver, you start to see why some analysts are using words like crisis and default risk when they talk about upcoming contract expiration periods. Let me paint you a picture of what's really happening. Imagine a game of musical chairs, but instead of chairs, it's physical silver bars sitting in vaults. And instead of a few people playing, you've got industrial manufacturers who need silver for solar panels and electronics. You've got investors who want physical metal. You've got ETFs that need to back their shares with real silver. And you've got futures traders who might actually want to take delivery. The music is still playing, but everyone's starting to notice there aren't enough chairs. And the smart players? They're not waiting for the music to stop. They're securing their chairs right now. Before we go deeper into this, I want to make sure you have access to something valuable. There's a free guide in the description below that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's completely free, and it might give you some perspective on what we're about to discuss. All right, let's continue. The industrial demand story is more compelling than most people realize. Silver isn't just used in jewelry or coins anymore. It's absolutely critical for the technology that's driving the next decade of growth. Every solar panel requires silver. Every electric vehicle uses significantly more silver than a traditional car. The AI boom everyone's talking about? Those data centers and advanced chips require silver. Nuclear power expansion, which is accelerating globally, needs silver. We're not talking about discretionary uses that can be substituted away. We're talking about applications where silver's unique properties, its conductivity, its reflectivity, its antimicrobial characteristics, make it irreplaceable. And here's the kicker. Industrial users don't care about the price the way investors do. If you're manufacturing solar panels or semiconductors and you need silver to complete your production, you're going to pay whatever it takes to secure your supply. You can't tell your customers, sorry, we couldn't finish your order because silver got too expensive. You pay the price and pass it along. That creates a floor under demand that's completely different from investment markets where people can choose to sit on the sidelines. Now, let's talk about what's happening with supply. Global silver production isn't keeping pace with demand. Mining companies are dealing with declining ore grades, meaning they have to process more rock to get the same amount of silver. Environmental regulations are tightening, which increases costs and complexity. And here's something most people don't know. About 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. So silver supply is largely dependent on the economics of those other metals. You can't just turn on more silver production when the price goes up. It doesn't work that way. The deficit we're seeing isn't a temporary blip. It's structural. And when you have a structural deficit in a commodity market, especially one where a significant portion of demand is industrial and price inelastic, you get a very different dynamic than in markets where supply and demand can quickly rebalance. The market can stay in deficit for years, with the gap being filled by above-ground inventories. But here's the thing about inventories. They're finite. And when they run low, that's when price discovery gets really interesting. Let's talk about the paper versus physical dynamic because this is where things get fascinating. The silver market has a massive paper market built on top of the physical market. Futures contracts, options, ETFs, allocated and unallocated accounts. For every ounce of physical silver, there are multiple claims on that silver through paper instruments. This works fine as long as most people are content to hold paper and don't actually want physical delivery. It's like a bank. Banks don't keep enough cash on hand to cover all deposits because they know most people won't withdraw everything at once. But what happens when people start wanting physical instead of paper? We're seeing early signs of this shift. The premiums on physical silver, the amount you pay above the spot price to actually get metal in your hand, have been elevated and volatile. Delivery times from major dealers have stretched out. Mints around the world are struggling to keep up with demand for coins and bars. These are symptoms of a market where the paper price and the physical reality are starting to diverge. And when that divergence becomes too large, something has to give. Think about the Hunt brothers situation back in the 80s. They tried to corner the silver market by taking massive physical delivery. The market changed the rules on them, raised margin requirements, restricted trading. They ultimately failed, but they exposed something important. The system is designed to discourage large-scale conversion from paper to physical. The infrastructure isn't built for it. The vaults don't have the capacity. The logistics don't exist. So what happens when it's not one or two players trying to take delivery, but a broad-based shift in preference from paper to physical, driven by industrial demand, investment demand, and concerns about counterparty risk? Here's where the 250-ounce number comes from. It's not arbitrary. When you look at the total above-ground silver inventories, the amount held in various forms, and you divide that by the number of households in developed economies who might reasonably want to hold some physical silver as part of their wealth preservation strategy, you get to numbers in that range. 250 ounces per household isn't hoarding. It's not cornering the market. It's just a reasonable allocation for someone who understands what's happening and wants to make sure they have access to physical metal before the supply situation gets more constrained. Let me give you some context on what 250 ounces represents. At current market prices, we're talking about a meaningful but not outrageous investment for someone who's serious about wealth preservation. It's enough to be significant if silver does what many analysts expect. It's enough that you're not going to be scrambling to find metal if premiums spike or availability becomes an issue. But it's not so much that you're betting the farm on one asset. It's a strategic position. Now I want to talk about something that doesn't get enough attention: the monetary history of silver. For thousands of years, silver was money, not an investment, not a commodity, money. The word for silver and the word for money are the same in many languages. When the United States was founded, the dollar was defined as a specific weight of silver. The Constitution gives Congress the power to coin money and regulate its value. And for most of American history, that meant silver and gold coins. What changed? In the 20th century, governments moved away from silver as money. They needed the flexibility to expand the money supply beyond what physical silver would allow. But here's what's interesting. Every time there's been a major monetary crisis or loss of confidence in paper currencies, people have returned to silver, not because of nostalgia, because silver has properties that make it valuable regardless of what any government says. It's scarce, it's durable, it's divisible, it's recognizable. It's been valued across cultures and throughout history. Those properties don't go away just because governments stopped using it as official money. We're living through a period of unprecedented monetary expansion. The amount of currency and credit in the global system has exploded over the past few decades, and especially over the past few years. When you create more units of currency, but you don't create more silver, what happens to the exchange rate between currency and silver? Basic economics says silver should become more expensive in currency terms. And yet, silver has been remarkably restrained compared to other assets. Why? Because the paper market has allowed price discovery to be dominated by futures trading rather than physical supply and demand. But that's changing. Let me tell you about what happened in the 70s. After Nixon closed the gold window and ended the Bretton Woods system, there was a period of monetary chaos. Inflation surged. Confidence in the dollar wavered, and silver went from around $1.50 an ounce to $50 an ounce in less than a decade. That's not a typo. $50. And this was when silver was still relatively common in coins, and industrial uses were a fraction of what they are today. The move wasn't driven by fundamentals alone. It was driven by a loss of confidence in paper money and a rush to hard assets. Could something similar happen today? The The setup is actually more compelling now than it was then. We have structural deficits in the physical market. We have massive industrial demand that didn't exist in the 70s. We have a paper market that's more leveraged than ever. We have monetary expansion that makes the 70s look tame. We have geopolitical tensions and concerns about the dollar's role as reserve currency. We have a generation of investors who've never experienced a real precious metals bull market and don't have silver on their radar. All of these factors create an environment where a repricing of silver isn't just possible, it's probable. But here's what's different from the 70s. Back then, you had two wealthy individuals, the Hunt brothers, trying to manipulate the market. Today, you have structural forces. You can't change the rules to stop industrial demand. You can't change the rules to stop a supply deficit. You can't change the rules to stop people from wanting to hold physical metal if they lose confidence in paper instruments. The market will find a way to balance, and that balance will come through price. Now let's talk about what smart money is doing. And I'm not talking about retail investors or even most financial advisors. I'm talking about the people who manage serious wealth, who have access to information and analysis that most people never see, who think in terms of decades rather than quarters. What are they doing with silver? They're accumulating physical, quietly, consistently. They're not trying to time the market or trade around positions. They're building strategic holdings of physical silver that they view as insurance and as a long-term store of value. They understand that in a world of unlimited paper currency creation, hard assets with real utility and limited supply become increasingly valuable. And they understand that silver, trading at a fraction of its inflation-adjusted all-time high, represents asymmetric opportunity. The downside is limited, the upside is substantial. Here's something that should concern anyone paying attention. The ratio between gold and silver prices has been historically volatile, but over long periods it tends to revert to certain ranges. Right now, that ratio is still elevated compared to historical averages. What does that mean? It means silver is cheap relative to gold. And when you consider that silver has industrial demand that gold doesn't, that silver supply is more constrained than gold supply, that silver inventories relative to annual production are much lower than gold, the case for silver outperforming gold becomes compelling. But let's bring this back to something practical. Why 250 ounces specifically? Because that's roughly the amount where you transition from dabbling to having a meaningful position. It's enough that if silver does what the fundamentals suggest it should do, you'll be glad you acted. It's enough that you're not dependent on finding metal at reasonable prices later when everyone else has figured out what's happening. It's enough to give you optionality and flexibility in different scenarios. Think about it this way. If you're holding paper assets, stocks, bonds, cash in the bank, you're dependent on the system functioning normally. You're dependent on counterparties honoring their obligations. You're dependent on the currency maintaining its purchasing power. Physical silver is different. It's an asset you control directly. It doesn't have counterparty risk. It can't be inflated away. It has intrinsic value based on its properties and uses. In a world where systemic risks are increasing, where monetary policy is experimental, where geopolitical tensions are rising, having a portion of your wealth in physical silver isn't speculation. It's prudence. Let me address something that comes up whenever people talk about holding physical precious metals: storage and security. This is a legitimate consideration. 250 ounces of silver is not insignificant in terms of weight and volume. You need to think about where you're going to keep it and how you're going to secure it. But here's the thing. These are solvable problems. People have been storing valuable items safely for thousands of years. Home safes, safety deposit boxes, private vault storage. There are options. And the cost and inconvenience of storage is trivial compared to the potential cost of not having physical metal when you need it. Now I want to shift gears and talk about something that's not getting enough attention in mainstream financial media: the role of silver in the transition to renewable energy and electric vehicles. This isn't some distant future scenario. This is happening right now. Governments around the world have committed to aggressive targets for reducing carbon emissions. That means massive build-outs of solar power. That means millions of electric vehicles. That means upgraded electrical grids. All of this requires silver. The solar industry alone is projected to consume enormous amounts of silver over the next decade. And here's what's critical. This demand is relatively price inelastic. If you're a solar company and silver goes up 20 or 30%, it doesn't change your business model. Silver is a small percentage of the total cost of a solar panel. You pay the higher price and move on. But if you're an investor or someone holding silver, that price increase matters a lot. You're seeing industrial users essentially bidding up the price of your holdings because they need the metal for production. Electric vehicles are another massive demand driver. A traditional internal combustion engine car uses about half an ounce of silver. An electric vehicle uses several times that amount. As EV adoption accelerates, and every major automaker is betting heavily on EVs, that's a structural increase in silver demand that's not going away. And again, this is price inelastic demand. Auto manufacturers need the silver to build the vehicles. They're not going to stop production because silver got more expensive. Let me tell you a story that illustrates what's happening. There's a major electronics manufacturer. I won't name them, but they're a household name. A few years ago, they started getting concerned about silver supply. Not because of the price, but because of availability. They were worried that at critical moments, they might not be able to source the silver they needed to maintain production. So they did something interesting. They started building a strategic inventory of physical silver. Not for investment, for operational security. They wanted to make sure they had metal on hand so they wouldn't be at the mercy of spot market availability. Now, think about what happens when multiple industrial users start thinking this way. When companies decide they need to hold larger inventories of silver as a buffer against supply disruptions, that's metal coming out of the available supply and sitting in corporate vaults. It's not being traded, it's not available to the market, it's locked up. And every ounce that gets locked up in industrial inventories is one less ounce available for investment demand or for backing paper instruments. This brings us to a critical point about market structure. The silver market is relatively small compared to other commodity markets. The total value of all the silver in the world, if you could somehow aggregate it, is a fraction of the market cap of a single large tech company. This means the market is susceptible to big moves when large pools of capital decide to allocate even a small percentage to silver. If pension funds, sovereign wealth funds, or large institutional investors decide they want exposure to silver, there simply isn't enough metal available to absorb that demand without significant price appreciation. And here's where it gets really interesting. Most institutional investors have zero allocation to physical silver. Zero. They might have some exposure through mining stocks or ETFs, but actual physical silver, it's not part of their portfolio construction. Why? Because for decades, the conventional wisdom has been that precious metals are relics, that they don't generate cash flow, that they're not productive assets. But that conventional wisdom is being challenged. When you have negative real interest rates, when you have concerns about currency debasement, when you have geopolitical instability, suddenly the characteristics that made precious metals seem obsolete start looking attractive again. What happens if institutional allocation to silver goes from 0 to even 1%? The amount of capital that would flow into the market would be staggering relative to the available supply. And unlike stocks, where companies can issue more shares, or bonds, where governments can issue more debt, you can't just create more silver. The supply is what it is. Price has to adjust to balance supply and demand. And when you have a supply deficit and increasing demand from multiple sources, that adjustment happens upward. Let me talk about something that's uncomfortable but important. The possibility of a COMEX default, or a major disruption in the paper-silver market. I'm not saying this will happen. I'm saying it's a risk that's being discussed seriously by people who understand market structure. When you have a situation where the amount of paper claims on silver far exceeds the physical silver available for delivery, and when you have increasing demand for physical delivery, you create the conditions for a squeeze. What would a squeeze look like? Imagine a scenario where a large number of futures contract holders decide they want physical delivery instead of rolling their contracts or settling in cash. The exchange has rules and mechanisms to handle this, but those mechanisms assume normal conditions. They assume most people don't want delivery. If that assumption breaks down, if suddenly a significant percentage of contract holders demand physical metal, the system would be stressed in ways it's not designed to handle. The exchange could change the rules. They could raise margin requirements. They could limit position sizes. They could even settle contracts in cash at a fixed price rather than allowing physical delivery. They've done things like this before in other markets when conditions got extreme. But here's the thing. If they do that, it would essentially be an admission that the paper market can't function as a price discovery mechanism for physical silver. It would validate the concerns of people who've been saying the paper market is disconnected from physical reality. And it would likely accelerate the shift from paper to physical. Now I want to address the retirement angle specifically because this is where the rubber meets the road for a lot of people. If you're in your 50s, 60s, or 70s, you've spent decades building wealth. You've saved, you've invested, you've been responsible, and now you're looking at a financial landscape that's very different from what you expected. Interest rates have been manipulated for years. The stock market is at valuations that historically have preceded major corrections. Real estate is expensive. Bonds don't yield enough to keep up with real inflation. Where do you put your wealth to preserve it? This is where physical silver becomes relevant. Not as a get-rich-quick scheme, not as a speculation, as a wealth preservation tool, as a way to hold value outside the financial system, as insurance against scenarios where paper assets don't perform the way you need them to. 250 ounces of silver for someone with a reasonable retirement nest egg is a strategic allocation that provides diversification and protection without requiring you to bet everything on one outcome. And here's something worth considering. If you're sitting on retirement accounts, IRAs, 401ks, you have options for holding physical precious metals within those accounts. It's called a gold IRA, though it can hold silver as well. The structure allows you to get physical metal into a tax-advantaged retirement account without triggering penalties or taxes. I put together a free guide on how this works. It's in the description. Covers the mechanics, the rules, the considerations. If you've got 100,000 or more in retirement accounts and you're thinking about diversification into physical metals, it's worth understanding how this structure works. No obligation, just information. All right, back to the analysis. Let's talk about what happens in different economic scenarios and how silver performs. In an inflationary environment where the purchasing power of currency is declining, hard assets tend to do well. Silver, as a tangible asset with industrial utility, benefits from inflation. In a deflationary environment where debt defaults and economic contraction dominate, silver's monetary properties become important. People want to hold assets that don't have counterparty risk. In a stagflationary environment where you have economic weakness combined with currency debasement, silver benefits from both the monetary demand and the fact that supply constraints make it valuable. The point is, silver has characteristics that make it relevant across different economic scenarios. It's not just a bet on one outcome, it's a hedge against multiple forms of instability. And in a world where the range of possible outcomes seems wider than it's been in decades, having assets that perform across different scenarios is valuable. Now let's talk about timing, because the question everyone asks is, when should I buy? And the honest answer is, nobody knows exactly when silver will make its next major move. Markets don't work on predictable schedules. But here's what we do know. The fundamentals are in place. The supply deficit is real. The industrial demand is growing. The paper market is stretched. The monetary environment is supportive. The geopolitical backdrop is uncertain. All of these factors create conditions where a significant repricing of silver is not just possible but likely. The risk of waiting is that you're trying to time something that might move faster than you expect. Silver has a history of long periods of consolidation followed by explosive moves. When it moves fast. If you wait for confirmation, for the move to be obvious, you'll be buying at much higher prices, and more importantly, you might be buying when availability is constrained and premiums are elevated. The time to position yourself is before the move, not during it. Think about the people who understood the housing bubble in the mid-2000s. They saw the fundamentals. They saw the unsustainable debt levels. They saw the fraud in mortgage underwriting. They knew it was going to end badly. But they couldn't tell you exactly when. Some of them were early. They looked wrong for a while. But when the crisis hit, they were positioned correctly. The same principle applies here. You position based on fundamentals, not on trying to predict exact timing. Here's another way to think about it. What's the cost of being wrong? If you buy physical silver and the price goes sideways or even down for a while, you still own the metal. You haven't lost anything unless you sell. Silver isn't going to zero. It has intrinsic value. It has industrial uses. It's been valued for thousands of years. The downside is limited. But what's the cost of not buying and being wrong about that? If silver does what the fundamentals suggest, if we see a major repricing, if availability becomes constrained, the cost of not acting is potentially much higher than the cost of acting and being early. Let me share something about how professional investors think about asymmetric opportunities. They look for situations where the potential upside significantly exceeds the potential downside, where you can risk one to make 5 or 10. Silver, at current levels, with current fundamentals, represents that kind of opportunity. The downside is limited by industrial demand and production costs. The upside is substantial if any of several catalysts play out. That's an attractive risk-reward profile. Now, I want to address something that comes up in discussions about precious metals. The idea that they won't let silver go up, that the market is manipulated and controlled. Look, I'm not naive about how markets work. There are large players with significant influence. There are mechanisms through which price can be influenced in the short term. But here's the thing about fundamentals. They eventually win. You can manipulate price in the short term through paper markets, but you can't create physical silver that doesn't exist. You can't eliminate a supply deficit through trading. You can't satisfy industrial demand with paper contracts. The Hunt brothers tried to corner the market and failed because the system changed the rules, but they were trying to manipulate the market. What's happening now is different. This is structural. This is multiple forces converging. Industrial demand, investment demand, supply constraints, monetary concerns. You can't change the rules to make solar panels not need silver. You can't change the rules to make electric vehicles not need silver. You can't change the rules to eliminate a supply deficit. The market will balance, and it will balance through price.